back to the financial topic, delving deep into implications of relevance for some of the topics that we've discussed today. Implementation of CBDCs imply adaptation of the monetary policy and how the central bank manages interest rates and reserves liquidity. So I'm happy to introduce Farid Bakr and Maxim Neshcheret, who would present the paper that, as I said, you can find also on the research library on the website.
Thank you very much. And that's the slides. How do you? Okay, it works. Hello, everyone. Thanks for staying in for so late. So many exciting discussions. I want to thank Professor Paolo Tasca for organizing the event, for inviting us as one of the paper presenters. So far, an excellent event. I would like to thank the National Bank of the Republic of Kazakhstan. As a former central banker, I feel here at home, and really shows how central banks are open to the public in terms of information transparency. I know about the time limit, so I will try to make my speech as brief as possible, particularly taking into account that we have so many practitioners as opposed to researchers and macroeconomists, something that I'm more used to. I do work currently as a regional director for Latin America and Europe at a large Asian fintech company called Patronum Tech. But my previous experience for many years has been money market analysis, bank sector liquidity analysis, and of course, a familiar and easy topic for me would be to discuss what happens when CBDC is introduced. We have discussed with, we have heard today from the representative of the Central Bank of the Republic of Turkey about different systems and their accessibility, about CBDC design and thinking of the final user of CBDC design. But essentially, on the background, this, of course, accessibility of financial instruments are very important, and this is part of the agenda of any central bank. But let's not forget about the mission of any central bank, which is price stability and financial market stability. And the first step in achieving financial market stability and price stability is, of course, monetary policy implementation, which is a set of toolkits that the central bank uses to make sure that interest rates in the financial market are close to the key policy rate. So we're going to talk about it really briefly. I understand that the audience is more, practice-oriented, business-oriented, rather than kind of discussing some research issues, but I want to briefly swing through the key findings and the reasons why we decided to write this paper. So nothing new will come out in terms of how CBDC affects monetary policy implementation, but the interesting twist will be a cross-country analysis that we do, and we did a pretty deep dive into monetary policy frameworks of the three jurisdictions where the central bank digital currency is about to be introduced. So essentially, the motivation for this paper, as I put it, is, today we talked a lot about the innovation, CBDC as innovation, tokenized assets as innovations, but at the same time for central banks, a very important issue is how CBDC will affect the way central bank implements the monetary policy and achieves the closeness of market rates to the key rate. So from that perspective, from the operational work perspective, CBDC adoption can alter reserve demands, which is commercial bank reserves at the central bank, can change bank liability composition, specifically taking into account that CBDCs in most jurisdictions are not thought as part of commercial bank balance sheet, but rather a liability directly to the central bank. And how basically this would affect liquidity forecasting later today. Later I will explain why this is important. And of course, the consequence of that would be the influence on money market rates. So essentially, we look at the concept of CBDC from two perspectives. On the one hand, there will be CBDC design, taken into account, holding limits, specifically for the ECB case, remuneration, institutional architecture, and on the other hand, we will look at how policy instruments are organized, what open market operations are run, what liquidity position is, and so on and so forth. Sorry. I wasn't intended to break anything here. Very briefly, of course, we all... Exactly, you're quite right. Financial system right now at a lot of risk. Very briefly, just when we look at any central bank and how he designs CBDCs, he usually thinks of this in a very, actually the first step is very simple. If CBDC, when introduced, just replaces cash, then of course not much happens, because cash has always been one of the so-called autonomous factors, one of the factors that suppose a liquidity drain or liquidity pop-up when cash is transformed into bank deposits. But when for some reason CBDC supersedes either supersedes commercial bank deposits, or cash is used for some reason more, then we have this liquidity drain. So we just need to bear that in mind, that in terms of autonomous factors that need to be taken into account for central bank monetary policy implementation, CBDC is absolutely harmless when it means that it's just a transition to cash, but can have certain implications for, for the regulation, for the operations, if it's moved to from commercial bank deposits into CBDCs, if there is a liquidity drain. And here I introduce another concept. It takes time to actually digest it in. It's well known in the specific qualified literature. Basically, we kind of approached this cross-country analysis from the perspective of operational framework, and one of the first elements that we need to look at is how generally central banks operate, and how kind of different situation with liquidity, with how much there is money on the commercial bank deposits affects the way interest rates react. So what these graphs show, I just wanted to stop on this one to give you a little bit of a framework, is that if there is a corridor system, if there is an upper and lower bound, the interest rates and the key interest rate, let's say, is targeted somewhere at the middle, then we have a situation where basically in a balanced liquidity position, where basically there is where banks don't have too much money on the current accounts, you have a situation where the demand curve for liquidity, the demand from commercial bank for reserves is highly elastic. And what it means is that any fragile mistake of how central banks forecast the demand for liquidity will result in higher volatility of interest rates. And at the same time, if you have a so-called structural surplus in the bank sector, you basically move the liquidity supply to the right, where actually the reaction, the response of interest rates and the need of commercial banks for liquidity is much less sensitive, and the response is much less sensitive. In this table, we kind of decided to sum up the instruments that are currently used by the three central banks that we researched. Is the ECB, the People's Bank of China, and the BCB. I won't stop on this one, but I will briefly, in 3 minutes, describe what we find about each jurisdiction. So the first case, we call it a benchmark case for the ECB, is, a classic story. Before the 2008 crisis, the central bank, the European Central Bank has a very balanced liquidity position, a very limited set of tools, and very efficient operational framework. What changes after the crisis is that the ECB has to run quantitative easing. As a result, there is more liquidity on current accounts, and we shift from a balanced liquidity position to structural liquidity surplus. So what happens is that all commercial banks have a lot of money on the current account at the central bank. And when this happens, there is no need for commercial banks to interact with each other. So why we call ECB an interesting use case is because at the time they introduced a slightly different operational framework, which was the floor system as opposed to corridor system, where you target, or the policy rate becomes the deposit rate. It means that because all banks just need to deposit somewhere the money, they basically use the deposit rate as the key policy rate. And two takeaways that I want you to take from the ECB example. First, it is the operational work is highly adaptable. It means when there was liquidity surplus, two-tiered system was introduced, access deposits were introduced, and this way the European Central Bank was able to incentivize money market activity. And at the same time, when the situation with interest rates normalized a couple of years ago, gradually, as we can see, particularly the negative side of the graph, gradually the ECB is returning to a smaller balance sheet and basically removing some of the operations. I'm not going to get into details because I'm actually short of time. From the perspective of introducing CBDC, what is important? From the structural strengths of ECB are the floor system that absorbs liquidity and allows the ECB to be less sensitive, or let's say commercial banks to be less sensitive to sudden liquidity drains, effective short-term rate control, and something that allows the ECB to guide target interest rates well. And in terms of the design of CBDC, something that we would like to highlight is that its whole design is made to make sure that there is no dramatic shift from the liquidity surplus to actually the balanced liquidity position. So from that perspective, the ECB case is interesting because they introduce holding limits, and that means, as I mentioned on the first slide, that means that basically you don't have this drain from commercial bank deposits into CBDCs. There is a certain limit which you can hold on the wallet. And of course, there's access exclusion. In our paper, we do not cover the Forex segment. The ECB explicitly excluded non-residents and corporates from CBDC holding, which makes the effect and the impact of digital euro on liquidity much less pronounced. I feel like I'm really running out of time, so I want to highlight some of the things that we find about People's Bank of China situation and the Central Bank of Brazil. 2 points that we would like to see. If the case of the ECB is a, let's say, benchmark for us, the cases of Chinese Central Bank, the People's Bank of China, and the BCB are, let's say, interesting creative diversions from that. When it comes to the People's Bank of China, one thing that stands out in terms of their operational policy is that they use long-term instruments, and as you can see on the balance sheet, there is a very large structural liquidity provision tool that basically not undermines but makes short-term operations, which in a rule book should be the primary operation of a central bank, which makes them less efficient in terms of transmitting the key policy rate. And a second feature is that the People's Bank of China, of course, regulates bank sector liquidity using required reserves. Again, this tool is becoming, sometimes is becoming in China a more informative policy tool. But how does this interact with the introduction of CBDC? An interesting twist in the case of China is that digital yuan will not be designed the same way as in Europe. In Europe, you have non-remunerated digital euros, so you can't open a deposit in digital euros. There is a holding limit, and digital euro will be a claim on the central bank, not a direct one, but indirectly, it's still a claim on the central bank. Digital yuan actually will be part of bank sector liquidity in China, and this is completely different setup, because it means that essentially the use of digital yuan is equal to the use of commercial bank deposit. You can deposit digital yuan at a bank, you still get, you earn an interest rate, and essentially nothing changes for you as a user. And again, for the People's Bank of China, there is no change either, for one simple reason, because again, this will be part of bank sector liquidity. Banks will be complying with required reserve obligations on digital yuan deposits. So from that perspective, what we find is that digital yuan is more about infrastructure provided by the central bank that competes with private wallets in China. So no risks of liquidity drain there, no risks for monetary policy implementation, and frankly speaking, when we were developing our recommendation toolkit, we saw absolutely no change in terms of how People's Bank of China would react to CBDC introduction. And a final thought to kind of give way to others is that essentially the Central Bank of Brazil is another exciting case. I don't have time to discuss it fully, but DRAC's introduction at the wholesale level definitely means that there will be very limited effect on bank sector liquidity and on the ability of the Central Bank of Brazil to steer money market rates towards the key policy rate. There is a completely different story that we wanted to cover that is related to government debt management and fiscal policy at the same time as monetary policy is implemented. But that's a whole different story. I'll leave you with a slide with our policy implications. Thank you very much for your time. Sorry for giving so many unknown terms in a very short space of time, but we really wanted to highlight this case. Thank you.
Thank you for being that ambitious. We can take a couple of questions. Do we have questions in the audience? Then I guess Java? Yes. Can you get another mic and I'll bring this to Java?
Yeah, sure.
Maxim, do you want to join? No?
Yeah, sorry. So the slides where you were showing that CBDC and the triangle, CBDC cash and commercial bank deposits, right? Effectively, there seems to be no kind of difference between CBDC and cash because you show them as if they were kind of equivalent, and then the commercial bank deposit they both add kind of liquidity constraint to them, right?
Yeah.
So I just feel, of course, we see that CBDC is kind of like a digital version of cash. But then later on, you also introduce an example of E, C, and Y, where they try to be where I guess the CBDC, the digital currency, try to be innovative and start to add features like interest accrual, which you wouldn't have with cash. I'm just wondering, like, what is the trade-off there? One is to have it completely cash-like. The other one is to start to compete with kind of the commercial banks.
Yeah, a very good question. That's an amazing one. Actually, I covered very little about the CBDC design. I kind of started off describing the operational framework in an audience that has a lot of expertise in payments. I apologize for that. As far as CBDC design is concerned, remuneration of CBDC deposits means that you have the certainty of depositing money at the central bank, almost having no risk, and being remunerated at market rates. So any person in this room, so here we're completely on board and I think at the same level of competency. If I have to choose between a deposit at a commercial bank and a deposit at the central bank, my choice is natural. If the interest rate is more or less the same, I see no reason why I should go to the commercial bank. So there is this problem of disintermediation every single time that you offer remuneration on deposits. The second thing that you mentioned is, of course, the case of digital yuan. So, in case of the Central Bank of Europe, European Central Bank, you have the design of CBDC where it is equivalent to cash. And the idea, the whole strategic idea was that it will be the technological version of cash in the future. So that's the whole point of European Central Bank approach. When it comes to digital yuan, things get slightly more interesting because this is a two-tier tokenized system where essentially digital yuan deposits are offered by commercial banks and probably at competing rates with traditional commercial banks, traditional commercial bank deposits, and the only difference being is the new infrastructure that will be used for managing the ledger of CBDCs. So essentially there is absolutely no change from the perspective of the Chinese case, in a sense that.
Yeah, this is where I don't understand. I probably should because I'm Chinese, but I still don't. Like, we already have e-money. We already have bank deposits in electronic form on your app. So what is the point of e-CNY if it's not even central bank money?
You're absolutely right. The only reason for introducing CBDC in the case of People's Bank of China is to offer the new infrastructure, is to offer the alternative to cash for the future. And essentially, the economic implication is the same.
But that is not right. It is offered by commercial banks. It is not offered by central banks. You were just saying.
Yes, the thing is, because it's a two-tier system.
Okay, they were offered by central banks to commercial banks and then distributed.
Exactly. There is a wholesale part of CBDC and the liquidity management on that in that layer, and there is a retail part of CBDC which by design is such that it competes with commercial market deposits. So basically, again, our perception is that it's a competition between technological solutions rather than economically different products. And there is no effect on bank sector liquidity because it's... Yeah.
I have a question. In your experience and moving forward, probably looking also at other countries that you didn't represent here in the study. So there is this actually you were touching actually just now. There is this type of relationship. There can be a healthy collaboration between the public and the private. So, of course, we have many examples beyond financial markets of public infrastructure that are basically serving public goods that are operated by private operators in many countries, in many developed countries, many developing countries. So the same for financial markets, when you have a commercial bank that help to transmit the money flow into the economy from the central bank digital money. So I think that from your examples, I'm not sure if this is the trend, but it looks like this is the trend. That's the central banks maintain control over the design architecture of the CBDC, but then the operations is delegated. Do you think this would be the trend, delegated to the private sector?
Well, to put it simple, again, we have the design by the central bank. We have a certain system, but again, let's say if we imagine that CBDC is some sort of a digital platform, then the central bank operates it. And what commercial banks do in most cases, in the classic case of digital euro, what payment service providers, what commercial banks do, they become interfaces for the client. So essentially, you open a digital wallet in one bank, and you see the balance in the app of another commercial bank. So this digital wallet is reflected in all your commercial bank apps. So what I'm trying to say is that this interaction is the interaction between the platform run and operated by the central bank and commercial banks serving as interface providers. So that would be the classic case, but again, there are so many details that I didn't manage to cover on the Brazilian and Chinese case.
We have a similar case in Indonesia. They had QRIS. It's a kind of an early stages of the CBDC. But what they have done, there were lots of payment companies and they brought them together. So I agree with Pablo actually that the design, at the end the central banks start regulating them and then they give the design. Private companies also involved, private payment companies, but at the end it is the decision by the central bank. So my guess is that central banks will not leave this space, but there will be some sort of a collaboration. That's why, I mean, it's not just about the technicalities, but what would be the purpose of the CBDC? It will be different for Indonesia, it will be different for Brazil, it will be different for ECB and so on. And the problem of this sort of research is that we don't have the actual data. It's more kind of more of a simulation that we use. We have similar papers, like unfortunately, that's why one option might be to use some sort of a similar CBDC-like things, like Curious of Indonesia is a good example. This is exactly what they have done. So I agree with Pablo actually in that regard.
Yeah. I don't know if I have to respond to that, but very quickly, generally, my friends, when we talk about CBDC design, we talk about the purpose, the economic purpose. If we want it the same as cash, if we want it for settlement between banks, for large volume operations, if I want to buy an apartment or a car, and using CBDCs, let's say using Drax in Brazil, you can use that wholesale infrastructure. So essentially, the cases are different. Indonesia, in Brazil, in China, the approach is different to what exactly will be understood as CBDC and what will be the functions. Again, remuneration, holding limits, one-tier or two-tier systems. When individuals hold balances directly in the central bank ledger, or through tokenization, they hold actually tokens at commercial banks. So all that in terms of CBDC design is relevant, and our kind of modest, humble attempt was to look at how different CBDC designs affect operational framework, and whether a certain jurisdiction is ready to introduce CBDC, or certain instruments, policy instruments need to be added. So
by the way, there's a new trend now, like the purposeful money, and the CBDCs are a good example for that. If your purpose is, for example, financial inclusion, you design your CBDC accordingly. And yesterday, actually, there was a design of CBDC for reducing corruption, which is also quite a reasonable argument. So I believe instead of thinking about the CBDC as a kind of a holistic way, because it will be difficult, none of the central banks will be very much eager to that. This will be good to frame it like a purpose CBDC, where you have a purpose first and then you design the CBDCs accordingly. I believe it can be a good starting point for most of the central banks.
Thank you. Thank you.